Instagram, and Facebook, we're live as well. I'm Ed, obviously Hutchinson Johnson's Weekly Q&A. This is Mark Van Dellen.
Hello, yeah.
Pronouncing it correctly. And Mark's actually joining us today to give us, he's actually a mortgage broker.
That's right.
And he's here to give us some advice more from that lending and mortgage side rather than the just real estate stuff that we kind of plow down your throats every week. So hopefully everyone's out there is good. It is a beautiful, beautiful day right now in Beverly Hills. Really kind of hot. I'm wearing my thicker suit today and it kind of becomes that kind of weird situation. But anyway, Mark, do you want to give them a bit of background about where you're from, what you do, and then we can get into sort of questions and updates?
Absolutely. Hi everyone, I'm Mark Van Dellen with Home Street Bank. And we are a kind of a hybrid. We are a bank, so we do also loans in-house, but we also broker loans as well. And so we have a whole plethora of different lending products that we offer. I've been in the business for 9 years now, upon graduating from University of Southern California in 2008 and my master's in urban planning in 2009. I fell into to mortgage lending and absolutely loved it. It was a difficult time when I first got into the industry in 2009 with the recession, but it's been fantastic learning experience to see basically the entire real estate industry just kind of build back up to what it is today. So I'm just happy to have this opportunity and be with you and talk mortgages.
And that must have been pretty crazy getting into it at that time. I'm sorry, I'm getting so hot. I'm just behind me in this suit. I'm gonna take it off, and I've got my picture.
You gotta get the light suit here.
I know. I actually just run out of light suits today. So that's really interesting because actually I got into real estate I think 2011, so a little bit after that. So actually a lot of the agents that I was talking with kind of had the horror stories.
Yeah.
And I was based in London at that time, and obviously that was a market that was similarly affected, kind of because of the knock-on effect of the US.
Right.
But how was that dealing with
it was, so I don't think anyone predicted how the pendulum swung in the entire other direction.
Yeah. Because the transactions were going
crazy. That's right. Yeah.
Right?
So 2006 through definitely 2000, basically the 2000s to 2007. Anyone could basically get a loan.
Yeah.
And it was a crazy time. A lot of loans being written up. I was in college at the time, so I didn't really get to experience that. But then going back into the market when pretty much almost virtually every bank was in either a lot of trouble or was just closed. And so the Dodd-Frank Act came into effect in 2010, and that basically shifted the regulation to a more regulated market.
Very strict,
right?
In terms of getting, because it was from what I read about, and obviously I wasn't in the market at the time, but it seems like a lot of people were they were trying to throw mortgages down your throat almost. It was okay, what can we do to basically get you for this mortgage? And obviously now looking back on it, I think that's a very negative way of trying to do something like that, because obviously a lot of people can't afford or don't have the stability in their lives necessarily to be able to pay a mortgage every month to keep up with that.
Right. And back then, I mean, basically, if you had a steady job, you were paid W-2, which is, just a steady salary job, and you had a lot of money in the bank, then you can get a loan. But pretty much virtually no one else could at that time.
That's incredible.
Yeah. And so, as home prices have kind of gone up and as banks have seen that there actually is a way to safely still do loans, but, also make them profitable, then that's where we kind of are today, where we have that hybrid of safely doing loans, but also at the same time doing a lot of loans.
Okay, and we've got some questions actually. I'm going to get onto that in a little bit. But anyway, guys, if you want any more advice on mortgages, we're going to go through some stuff here. I'm going to do a little update. But Mark is a great resource, and actually we had a coffee last week, which was actually our first meeting, and really got along really well. So if people want to reach out to you, you're on Instagram?
That's right, MVD_home loans.
Home loans, okay, fantastic. So we'll put up a tag of that, and if any of you guys want us to repeat that, let us know, message us directly, we'll put that up there. And presumably you're based in Pasadena?
That's right. Based in Pasadena, we Home Street is actually their corporate headquarters is in Seattle.
Okay.
They're the official bank of the Seattle Seahawks.
That's pretty awesome.
Even the CEO has actually a Super Bowl ring from when they won the Super Bowl like a couple of years ago.
That's awesome.
But they decided to expand around 2012 into Southern California.
Okay.
And so we have about 19 office branches, both lending and banking branches in Southern California. And Pasadena, the branch that I'm at, is actually the first one in Southern California.
Okay.
Yeah.
So you cover most of Southern California?
We actually, I could do loans. I'm licensed to do loans in every state that Home Street does loans in, which is 10 states.
Wow.
But obviously, I focus my business primarily in Southern California and Pasadena, all the way down to Beverly Hills and Santa Monica, of course.
Yeah.
And and that's I've been born and raised here, so I'm most comfortable with it.
Yeah,
for sure.
definitely doing business with you know and you love.
Yeah.
I'll give you guys a quick update on just how our week has been. Unfortunately, David and Nick are not here today. David's actually, I believe, on his way to a music festival, so he's going to have an awesome time, hopefully, there. Go and check out his account, because I'm sure that there'll be some videos that he's posting of like him having a great time. We've actually removed contingencies on one of our deals yesterday, which was great news for us. Unfortunately, another one fell out of escrow. So it kind of that, I always talk about with our community here, like the sort of ups and downs of real estate, and I presume it's very similar with mortgages.
Absolutely.
You're arranging a huge loan for someone to get a property, and you've done all of the legwork, and then suddenly, for some reason, completely out of your control, it falls apart.
Right. What was some of the hurdles on that?
So weirdly, actually, the property that we had contingencies removed on, the actual investor was kind of sort of second thinking it before removing contingencies, decided that actually after looking at the spreadsheet and the return, because it was a property they're going to knock down and build multiple units on that lot, they decided that was great, and actually we were having a little bit of that sort of hot under the collar moment where we were like, what happens if he just turns around and says he doesn't want to buy it? We've done all the work, we've done the environmental surveys, like I was getting up at 6 a.m. to drive to North Hollywood to go and do all of that. So there was definitely that. With the other property, it was actually weirdly pressure coming from the current owner, who I think realised that he had undersold the property. And obviously we had it agreed and in contract. And actually our developers were looking at it and they were like, there's no way this guy can actually pull out of the deal because we've got a signed contract. We're going through the processes of what we want to do to buy it. But they did not want to just get into a sort of a situation where it was tit for tat, what are you doing, what am I doing, especially when we've got another 25 days left in the deal.
Right.
So that one they pulled out of. We've actually got a couple more options that they're looking at the moment. So that again, I was talking to Nick, actually our team member, about that yesterday, and just saying we just never get attached to a deal until it's signed, done, and I presume that's the same.
One of the first lessons I learned in lending back in 2010 is it's not until the paperwork is signed and that the funds are actually at title or at escrow is this deal closed. Yeah. I've seen it all, for sure.
That's definitely the case. So if anyone out there actually has any tips on what they do in terms of an ups and a downs, and thank you guys for comments. If you have any questions, definitely put them up there as well, because we would love to answer anything that you would like to know. Hey Scott as well, I can see you said hi to Mark.
Hey Scott.
Scott, as well.
Yeah,
that's another connection we have. So that's been good for us at the moment. I was actually out surfing this morning, which I haven't been for 4 days, which was a bit crazy for me. I think my brain starts to go a little bit crazy and I haven't had my morning sort of routine or exercise. So that was really fun. Caught up with actually an old friend this morning. That was, again, I just kind of like sitting around bobbing in the water, and it's more like a mental thing, I think, than actually physical. It does that kind of feeling. So Nick's actually had a coffee this morning. So we've had a couple of really busy days. A lot of prospecting new deals. We've got some good things I hope on the horizon, and a lot of new content actually that we're editing. So if you guys have any questions, have any feedback, if you think we're doing something awfully and you think we could do something better, we would love to hear any of your suggestions, because we will put those in. Okay, so Brian, what do you use to edit your, I presume that's Instagram, it came off as Insta1 videos. Oh, that could be the 360 camera that we use.
Oh, cool.
With this,
I saw that. It has like a remote with it.
It does. So basically, it's almost, and actually I've got it there and I should have brought it out. We've talked through it in the past on some of these forums, but actually I should really sort of retouch on it because we're really enjoying using it. But basically it is literally like a little camera this size. It's got 2 lenses, one on each side, and it can plug in the bottom of your phone. So you can kind of use it and sort of see what you're recording. You can also stick it or just hold it or stick it on a selfie stick. Mm-hmm. And the amount of updates that these things are doing, 360 videos. So actually to edit those, I use the app that's provided with the camera. So actually I just plug it back into my phone. I will sort of play around with that. It's got a really cool feature actually, which I've started playing around with, which is called the bullet time or bullet mode, I believe. So what it does is you kind of can put it on a selfie stick, and if you rotate it around you, it focuses back on the center of where you're rotating. Wow. And then stitches the stick out of it. So like I've had a lot of people actually reach out to me, Brian, like similarly, and said, are you using a mini drone to almost like follow you?
Yeah.
And then in some of the shots, I think where we've kind of lost a bit of connection here. Sorry guys for that. 1 second. I think it's just our Wi-Fi. Our Wi-Fi in this office actually can get really bad. I don't know what it is. They've kind of switched it over recently. And we're reconnecting, I think. Sorry, Facebook. So I'll answer your question, Brian. Our Instagram has kind of gone down for a little bit and it's trying to reconnect now. So what I do is I use the app to edit it. It's quite easy and actually pretty useful to use. The other thing that we actually also do is I've started playing around with iMovie, and actually like we have an editor who edits a lot of our stuff for us, and we kind of give him access to the drive. But what I have found is that it is really, really lovely to actually kind of learn the practicality of editing that stuff, because that's where we see it almost going in the future. So we'll see how my sort of skill set evolves in that way, but I don't know.
I mean, it's amazing though when you think about it. Like that used to be even 5 years ago.
Yeah.
Something to do like that would be at a studio with $100,000 cameras and equipment.
Yeah, it was millions of dollars of production.
Oh yeah.
To then just sort of, and then the distribution on top of that. And that's I think where we've really actually kind of come into our own here is, well, I mean, having access to now what the iPhone does.
It's insane.
And now, so we've got a couple of little drones that we love playing around with. Obviously, the quality is not quite probably what we need for the professional level for our listings. But to be able to just showcase like the different ways that we're doing stuff, like I'm really, really enjoying it. Yeah. So I think it's one to watch for the future. We're definitely keeping a very keen eye on VR, AR. Because I think that's probably going to be a big changer in terms of showings. Like we've kind of got this vision actually where at the moment if I've got a client, I'm taking them out to 10 houses to show them properties. And generally, there's a lot of organisation that goes into that. There's 5 people's schedules for each showing. You're liaising, you're getting the timing all set up. What I do see is with these 360 cameras, Brian, that you see us using, is that at the point where we can easily shoot the internals of a property, this office, because a lot of the agents actually just work from home, would probably be used to just having as almost a VR pod. You go in there, you do virtual showings of 100 houses, you cut that down to your 3 that you really like, and then you go and see those 3 in real life.
That's crazy.
Because I think getting rid of that friction is definitely something in real estate that seems to be the way that we're going. Anyway, so we had a couple of questions for Mark. Obviously focuses on mortgages, and actually we get a lot of knowledge on that from people that we're dealing with, and speaking to sort of experts like you, but we're not in it every day, and I think that there's a huge value to that, and especially for the community that we're trying to sort of provide some value to be able to have your opinion on sort of what's going on.
Sure. Happy to do it.
So one of the questions that we've got is, what is the future of mortgage rates over the next 12 months in your opinion? Obviously I know that you're not Nostradamus and you can't predict what everything's going to happen, but I'm sure that you over the years get a good feeling and an idea of where you would potentially see it going.
So I think I'm probably in the camp where most people are, where rates will be on the rise in the next definitely 12 months, even more.
So we've seen that actually over the last couple of months, haven't we? I think.
Yes. Yeah, so we've actually seen 2 rate hikes even just this year.
Wow.
So what the Fed is doing is they've even alerted that they're going to be doing at least a 25 basis point hike each quarter. So from year of 2018 to 2019, you're at like a full point above.
Wow.
And I don't know if anyone doesn't know, mortgage rates are kind of predicated on what the Treasury sets their rate at.
Yeah.
And then, it does trade daily, sometimes a couple times a day on the rate, but really that's the standard is the Treasury rate, and then they kind of take their cues, most banks do, take their cues from that.
Yeah, okay.
So that's, I think, but when you look at it like holistically, the rates really are still historically low when you look at like the past 20 years, even before that.
Because I suppose after that 2008 situation, we kind of had a sort of downward trend where actually like it kind of it hit the base rate of pretty low.
I mean there was
0%.
Rates at like 3%.
Yeah.
I never saw any lower than 3%
Okay.
rates, but they were about that's about as low as you can. The Treasury at itself was like 0%. So and that was just all that was to do is to try to stimulate the economy, to have low rates, to encourage people to obtain credit.
Money is cheaper, and
right.
therefore you can sort of get hold of
Exactly.
it easier. You can do what you're trying to do. Because I think that's an odd trend that I've definitely seen, because I've owned a house since 2012 in London, and for that reason, like I've always seen the rate to be this level. I've had conversations with my parents when they bought their house in the 80s. And it was 13-14%.
Yes. Yeah.
But there's this odd, I think this human nature where people just shift to, oh, well, it's been like that for a couple of years. That's the norm.
Right.
Unless you've sort of experienced prior to that. Yeah. So do you see, if the rates go up 1%, so we're kind of sitting 5%, that sort of level by next year, does that start to reduce the amount of people that are sort of qualifying for those loans? And
Yes, it would.
Yeah.
As rates go up, then obviously the expense of a home it gets a lot more expensive.
Yeah.
However, you kind of always have to look at renting too. It's always that same, the same adage of renting versus buying. What's better?
Yeah.
And obviously in the short term, probably renting is always better. Mm-hmm. But in the long term, investment wise, buying is always better. Usually at the break-even point, like 5 plus years is where buying actually ends up being better for you, because what you're doing is you're locking in your rent.
Yeah.
Because you're now in a fixed rate for 30 years.
Yeah.
Whereas rent will increase, probably at least 2% rental appreciation.
And you're not really, I suppose when you're paying the mortgage, you're actually you're actually putting money into the property that you borrowed.
That's right.
You're paying that back.
Yeah.
And so when you come to sell it, your equity, you've grown in that. When you're renting, you're paying someone else's mortgage.
That's right.
Which I think is
That's
always
true.
It's quite.
That's true.
I've got a couple of rental properties in London that I own, and it's amazing.
Yeah.
To be able to have just kind of leave it, forget about it,
right.
have someone else looking after the property.
Right.
It's going up in value as the market goes up, and I'm also accruing. I'm obviously paying the interest, but there's more money going into those
right.
properties. It's
and
for
probably
me
the rent is paying at least a huge portion of your mortgage.
Absolutely. The other thing as well I find is quite strange is because we're in LA and rent is so expensive in certain areas. Yeah. Some of the leases that we're doing, I think we've got actually a 1-bedroom lease that we have in Venice at the moment that we just leased, and that is $8,000 a month. And so I'm looking at that and I'm like, okay, well if you have enough for a down payment, $8,000 a month is going to get you a considerable size mortgage.
Right.
And you'd be able to buy something which is, pretty much comparable or better maybe than actually what you're paying to rent it.
Yeah, I mean there's a lot of reasons why they may not want to. It could be flexibility.
Yeah.
Because now when you buy something that becomes yours, you have to figure out how to maintain it, whether it be hiring a property manager or whatever, or yourself.
Yeah.
So flexibility is kind of an issue, but of course home ownership, owning that house would be way more cost effective, than paying $8,000 a month in rent, and I'm sure $10,000 next year and $12,000 the year after that.
And so, we're kind of getting a bit off the topic. I'm just getting really into actually discussing this because I think actually it's really interesting for you guys. So let us know if you have any questions related to it. But what I always find as well is the tax system here is kind of geared, or has been prior to sort of this year, where you can basically write off your property taxes against your income tax.
That's right.
And then I'm kind of looking at it like if I was a renter, and we're very fortunate, my wife and I, to own our house here. But if I was a renter, I'd be earning, if I earned $100,000 a year, I'm paying 40% tax on that. I'm pulling home $60,000, and then that $8,000 a month, or you can't even do that for that, but that $4,000 a month is going into rent. You're kind of not making any money. Whereas I suppose at least, even though the property taxes are fairly high in comparison to London at least, you're kind of saying, right, well, I've paid that in income tax, I'm going to kind of write that off. I believe that's now capped though, actually, I think.
Yeah, so the new tax law has the mortgage deduction at $750,000, where it was previously $1 million.
Yeah.
And you can deduct the interest on that.
Okay.
But what's more significant is the fact that there's a standard deduction now. So a married couple can deduct $24,000 from their income.
Wow.
And so in most cases now, if you add your interest mortgage and you add your property taxes and you add other deductions like gifts and all that, you still probably won't get to that base of $28,000.
Wow.
So it's almost like the standard deduction will always take over from that.
Yeah.
Which it might, in some cases, disincentivize home buying, but. I think in most cases it probably still
with the average price across the US.
That's right. Yeah,
it's not going to be that high.
And you have a $750,000 and it's up there. Still at least nationwide
for most markets. And I think that's where I get slightly disillusioned because our average price point here in a lot of our markets is
it's like
$2 million.
yeah.
And so it gets a little bit but we're not the norm.
On that topic though, I think California I think is one of the best states in the United States to actually buy property.
Yeah.
And the reason for that is the property taxes. It's pretty low here in relation to other states.
Yes.
At 1.25%, and most cases it's lower.
Yeah.
And it's fixed
on the purchase price.
Yes.
Which is actually something amazing that I find because. We have some sort of places here where gentrification is sort of fought against massively. Where I live in Venice, there's a lot of, why are the prices going up so much? Why is the demand here? Gentrification, get it out. But I imagine in those other states where it's not done on your purchase price, if someone is buying a home in an area and in 20 years, suddenly that area becomes insanely more valuable. Obviously I know that they generally have a cap on what they can kind of bring it up every year, but you can get priced out of your own home, which is to me is quite crazy.
That's crazy. It definitely could happen. And that's when you're talking about gentrification, that's a huge problem.
And so I suppose California sort of being that kind of balance of trying to
it's like, in every state they're going to get their taxes some way.
Yeah.
So whether it be sales tax, whether it be income tax, or whether it be property tax. It just so happens California is one of those states where they encourage home ownership.
Yeah.
And so those taxes are way lower. Yeah, income tax is a little higher than most states and sales tax, but and we also have the sunshine tax, so because it's just beautiful here every day. So there you go.
It's a great place to live. Okay, so let's move on. That was really interesting, though, Mark. I really actually liked getting your take on it because I think I can run it in my head so many times, and then actually getting another perspective, which is a lot more educated than I am. Okay, so this is actually more of a bit of an advice for someone who's looking to buy a house.
Okay.
Say someone is looking to buy a home in the next 1 to 5 years. They've literally decided on that last night, and their finances may be fine, but are there steps that you would say are the best things that they can focus on to put themselves in the best position in that time frame where they're going to be able to get the best mortgage and effectively be able to buy the best house that they can?
Absolutely. So I think there's three main things that home buyers should focus on. And even before even looking at a house, I think to see what price range you need you need to go through these steps. The first is credit. The credit scores, I couldn't do loans as low as 580 on a credit score. Okay. That's an FHA loan. Those are expensive loans.
Because the sort of risk from a bank's perspective is a lot higher.
Right.
It's not going to be paid back.
So it's an expensive loan to the home buyer, but they actually could, do it.
Okay.
The best loan that you could possibly have is if you have, I was going through credit, then income is important.
Yeah.
And I can go into what like a debt to income ratio means and why that's important. And then the third is your assets, your down payment, how much down. So when you combine all those three, the cheapest, best cost-effective loan you can do is a 20% down at least.
Yeah.
And a credit score of 680 plus.
Okay.
And so if you have that combination, that's where you're going to really get the best rate at that time and just pretty much it'll be time effective too.
Yeah.
I know there's close of escrow dates that are always looming and that are, become very, hard to navigate around.
Definitely.
And so something like a 20% down, 680 credit score, good income, of course, that's going to slide right through most banks.
Okay. So in terms of sort of building the credit score, is that just getting a credit card, making sure you're paying it off on time, and if you have any sort of loans on a car or anything like that, just making sure that there's never any delay? Is that the best way to build the credit score that you need?
Yeah, so it's in a couple ways. First, obviously, no late payments.
Yeah.
That will immediately ding your credit, pretty extensively. So even if you're on a credit card and you're just trying at least make the minimum payment, it's best to pay off the entire balance.
Okay.
So it looks at how many accounts you have. It looks at what your how many accounts you have, and then a lot of different the mixture, the outstanding balance that you have on that, and for how long has your credit been there.
Okay.
So those all factor into the credit score. But to be honest, like if you're at 680 plus, and it's not, if you're making on-time payments, if you're just doing that and you have a couple of credit cards, you're gonna get the 680 credit score.
So that's good to know.
Yeah.
Because actually that was a weird one for me, because obviously I moved here from the UK.
Right.
I had a non-existent credit score here, and because I just hadn't ever taken out a credit card. So that was always the weird thing. Like I always tried in the UK to almost not spend on my credit card and spend out of my debit account because I didn't want to go into debt. It seems here, if you do that, you're not building credit.
That's right.
So it's almost, as opposed to spending out of your debit account, you want to get a credit card, make sure you're spending within your means and you're paying it off on time to build that reputation.
Right. And what it is the credit agencies are looking at that and saying like, well, why doesn't he have credit?
Yeah.
Like why doesn't he have a credit card? Is that because he couldn't qualify?
Yeah.
And they start second guessing, and that's just the reason why you need at least one or two credit cards, even if you don't even use it, if you use debit, just to have it open and never close the account.
Okay, so that's a good one. So definitely get that and make sure you're doing that. Right. Presumably then you're saving money for that deposit to build it as much as you can.
That's right.
And that hopefully will put you in a position to get the best sort of property, mortgage and rate that you're going to get.
And then, to piggyback on that as well is, I know, like coming up with 20% down isn't the easiest thing here, especially in Beverly Hills. There are a lot of different loan programs. I mean, we can do on jumbo loans, meaning loans above $650 in loan amount. Can do up to 10% down. Okay. And no mortgage insurance. And I can go into what mortgage insurance is, but
we can do that actually another day.
So so it definitely exists. It's just maybe the rate's going to be a little higher when you do something like that. Yeah. And then also another option is to do an adjustable rate. And that, whereas usually it's like a 7-1 ARM is what they call it, or a 10-1 ARM. Yeah. That means it's fixed for 7 years and then adjustable every year after that. Okay. Why that might be beneficial is that the rate is typically lower than a 30-year fixed for those first 7 fixed years. Okay. And then so if it's like a starter home and you don't think you're going to be in the home for more than 7 years, that might be a good option because you're saving money as a lower rate, and then you're going to be moving anyway when it does become adjustable. And whenever that, who knows what the market's going to be like then. Okay, awesome. And I think that's really good. And actually, that's a question that we get a lot is it live? And my wife is writing, yes, it is live. Good to see you, Skate. Thanks for tuning in. Hello.
So yeah, because that's actually a question I get a lot, is kind of just more actually in the friends sort of circle and, you know, people that I meet and sort of just generally having passing conversations about real estate, as opposed to a client that's gone through the pre-approval and kind of understands what they're doing. It's always, okay, I have this much in my bank account, what kind of property can I buy? And obviously I think that 20% number is quite a good guiding factor in this. You know, if you've got that much, times it by 5, and as long as your income is at a level that can support the repayments on that,
that's right.
Then that's kind of where you're looking as a ballpark.
Yeah.
Okay.
And so that's the benchmark.
Yeah. Okay.
If you do 20% and you have at least a steady job where you can show at least 2 years of income, that's going to be your best loan you'll have. That exists.
With the 20%, obviously, then you're sort of opening the good rates. Is there a level at which you're putting 50% down, 80% down, where the rates are really start to get a lot better?
Yeah, see, that's funny. Not really, no. Okay. It's really like the rate is going to be the best at 20% down or more.
Or more, okay.
Yeah, obviously if you put 50% down, your monthly payment is a lot lower.
Because you're borrowing less money.
Right, but your rate is pretty much the same, especially if it's a, usually like it's a Fannie Mae, that's like the vanilla loan, a Fannie Mae 30-year fixed loan.
Okay, that's good to know.
Yeah.
Awesome, thanks Mark. So, next one, and actually this is going back to what we were discussing earlier. Are you seeing any signs of the relaxing of the lending requirements and a return to what we saw happen in 2007, where they were just trying to push mortgages on anyone who maybe were not necessarily qualified to potentially have that much money interest rate?
Yeah, that's a really good question. I'm seeing regulation, the supporting documentation actually not be as strict and stringent as it used to be.
Okay.
So it used to be like, if you were to provide a pay stub, that needs to be directly from your payroll company, ADP.
Yeah.
Now you could literally print it and then take a picture and send it. At least that's what I see at Home Street Bank.
And is obviously the risk there is someone forges it or is creating a document that's not, and have you seen that happen at all, or is that just...
I have not seen that happen, and there's so many checks and balances too, because we also call the employer as a verification of employment, so those types of things. So it's almost like back in 2010, it was so stringent because it was kind of like,
the fallout of what
the fallout, right? Yeah. And so now it's a little more practical, I think. Banks are realizing that there's a lot to be made in loans, but you can also do it safely.
Okay.
So what was really the problem, I think, in 2007 or 8 is that there were subprime loans that were then mixed with AAA rated loans, like very safe loans.
And they packaged them to make them look like these incredible sort of loans that people are paying back, and they're rated at that AAA level, but they weren't.
That's right.
So it was completely sort of like a bit of fraud in that way.
It definitely was. I think so. And so investors who were buying loans didn't really know what they were buying, because there was really good loans in that same package, really bad loans. But it was all looked like it was a good loan.
Okay.
So now I think as long as, and that's what I'm seeing right now, is there are subprime loans out there. You can get no income verification loans, and you pay a real high rate and you have a low credit score and stuff like that. There are loans that exist like that, but as long as those are separated from good loans and investors know what they're buying, then I don't particularly see a problem with that.
Okay.
And so that's where I do see it opening up more in terms of loan products that are available, but I also see it being done safely, at least for now.
So it's a return to normality, as opposed to let's go back to what we were doing in 2007 and kind of overdoing that kind of thing. Okay, well that's really good, and actually I think that's good for anyone who's potentially looking to buy a home, because hopefully that means that there's more sort of range of products that they can potentially qualify for.
Right. And a safer, more stable, housing market.
Yeah, and hopefully that's good for the economy and doesn't lead us down that same sort of path.
Right.
Hi in South Korea, by the way, as well. I just see someone sort of mentioning there. So thank you so much, guys, for tuning in. I think that's sort of it in terms of us, and hopefully you guys found this really interesting and engaging. This is Mark Van Dellen, and what I'm going to do actually after this feed is I'm going to put a little sort of black screen with his tag on it. So if you have any questions based on what we've been talking about, if you just are looking actually to get a mortgage and you want to talk through any of those processes, definitely reach out to Mark. He's incredibly easy to speak to get some information and some advice from.
Thank you.
And absolutely follow his Instagram, because that's, I think, where we see, and we're quite aligned on that.
Yeah. Oh, absolutely.
Is where we see business, and especially within that sort of real estate market, is how do you sort of stand out from the crowd? And where people are actually getting information. And I don't think I've actually seen some people discuss mortgages maybe in the detail that we have here, and I hope it didn't get too boring for you guys. But we'll be back next week at 10:30 with another Q&A. We'll be back on Tuesday with LA Mansion Tours, which actually you should join us on one week.
Yeah, I would love to.
Yeah.
I'm a huge avid follower of LA Mansion Tours on Tuesday. Yeah, I'm
Tuesday.
like, seriously, sometimes I like my first thought is coffee in the morning on Tuesday mornings, but then my second thought is like, oh, it's LA Mansion Tours. Ed's going to show us around.
That's good feedback. That's what we're trying to do.
Yeah.
Hopefully you guys are feeling the same on that.
I love it.
Difficult for me, and it's probably... Thank you for posting nice houses, absolutely. So guys, thank you so much for tuning in. As always, if you have any feedback for us, we would love to hear it. I'm sure, Matt, we'll have you back for sure, because this has been fantastic to sort of discuss.
Happy to do it.
And hope all of you guys out there have a fantastic weekend. So this is us signing out. I'm Ed Hutchinson.
And I'm Mark Van Dellen.
And we'll have his contact details on the screen, and hope you guys have a great rest of your day. Enjoy the rest of your Friday, and have a fantastic weekend. See you guys later.